Over now to Mark Todd from FIIG Securities in Sydney. We're going to take a bit of a look at the fixed income space, particularly in the wake of the US passing that federal budget. Mark, great to have you on board. I suppose, look, progress has been made, if you like, but I'd suggest it's going to be a long way to go before everything is resolved in the US over, deficit cuts and so forth.
Yeah, hi James, how are you? The market in the US is still fairly rancorous in terms of the political debate, so that adds to some uncertainty around what the markets are going to do, and we're going into a fairly long election cycle now. The US president's come out and he's sort of laid the mandate, or he's looking for the mandate on how they will, repair their balance sheet. And so at the moment we've got people on the right and the left, and there's not much in the middle, so there's a lot of fighting happening. With that in mind then, would you expect this, I suppose, this rhetoric and quite combative rhetoric to continue, and what sort of an impact is that likely to have on markets, in particular that fixed income space? Yeah, I think the rhetoric is fairly aggressive at the moment, and I think it's driven by both their bases. They've got, as you can imagine, the Republican base is driven a lot by the Tea Party, and that's very aggressive. And so the left is not as aggressive at the moment because I think they're very keen to not put any obstacles in the way of Obama. So when politicians get aggressive, I think investors get nervous, and so I think you'll see the trend going towards looking for some safety in assets, so some safe harbour investing. In terms of, I suppose, a flow onto that, do you expect, as a result of the volatility and the uncertainty, that will create an increased interest in the bond market? Yeah, I think, inflation is a driver in the questions about the bond market assets, but if you're seeing volatility in equity markets, I think you tend to move towards the debt markets, and there's been a lot of volatility in equity, so, we're just seeing a growth in bond investments across the curve at the moment. And I suppose one of the big issues coming up, really, I suppose, for global markets at the moment is the potential end of quantitative easing. We know that QE2 is meant to come to an end in June. Interesting, though, I mean, flipping a coin as to half the people we speak to seem to think there's a good chance of a QE3. The other half say, look, no chance. Where do you sit? Oh, no chance. I mean, I think if you look at the recent vote with the budget, I think it was 56 Republicans abstained from voting. They voted against that budget. Now, the Republican Party had driven that agenda, and so they still voted against it because they're appealing to their base, and their base is saying, we need to stand on our own 2 feet, we need to repair this balance sheet, and they won't have any QE3. There's just no appetite for that sort of fight at the moment. Do you think there's more of an appetite for interest rates potentially move high in the US, with Rob Henderson suggesting the fourth quarter this year? Even some of these Fed presidents around, Plosser in particular, look, at the moment, no imminent danger of accelerated inflation, but he's suggesting there's going to be a big shift in monetary policy in the not-too-distant future. I wouldn't be claiming that yet. I think there's a couple of trigger points. QE2 is very important. So if the lack of stimulus means the markets drop in terms of the contraction in the economy, you won't see any movement in cash rates at all. And I think there's some significance around the employment piece. The level of employment at the moment is poor in the United States. They've got a jobless recovery. So as their economies get better, their companies are getting better, they're just not employing people, they're making them work harder for less. So I don't see, from a policy perspective, that you're going to say the answer to this is to raise interest rates. I'm not seeing that yet. What about then, going back to quantitative easing, when we come to an end, we do know, or at least anecdotally, that a lot of this excess liquidity, this cash that's being printed, is finding itself in risk-weighted assets like equities, currencies and so forth. Sure. Do you expect that we might see some sort of a drop when it comes to an end, when they turn the taps off? I mean, personally, that's what I'd expect. I'd expect once you've seen the lack of liquidity, we call it the deleveraging. Once you lose that liquidity, that you'll sell the liquid asset, which will be your equity piece, because you've had there's a lot of buffer in that. You've had a lot of run up. So I actually think over the next 2 months, as we start to see that easing, it'll be a lot more volatile. Investors become nervous, and they'll start to liquidate as they perceive a change in that policy coming through. All right, Mark, always good to talk.